Investments in securities market are subject to market risks. Read all the related documents carefully before investing. Registration granted by SEBI, membership of BASL, and certification from NASM in no way guarantee performance of the intermediary or provide any assurance of returns to investors.
Welcome to our podcast session, and thank you for taking your busy time from your busy schedule. And happy Diwali 2025, right?
You and happy Diwali to you too,
Yeah,
and to all the
all of us are looking towards next Diwali for a better markets. Now, the last 1 year, the markets have not grown at all, but I think hopefully next 1 year, right, it's going to be better than what it was the last 1 year. But I wanted to, in this session, I wanted to go a little longer, maybe, a decade or so, and you have seen the markets for the last 3-4 decades, right? And there are a lot of emerging trends that you would have seen, right? Way back, when you would have started in 90s, before the 2000 decade, if somebody were to invest in a mutual fund, he must have been a very daring person, right? So, but now I think that things have changed, right? From that pre-2000 to now, right? Almost everybody looked towards a mutual fund, and with the mutual fund SAE campaign, right? So a lot of things have changed, and the trends have changed, and trends keeps changing every decade, right? So, and especially as investors, what most of the investors end up doing is whatever has happened in the past, right? We take it as a, some kind of a guarantee, that assumptions, because we have nothing else to, right? All our assumptions are based on what has happened in the past, right? And then we try to, build our portfolio expectations or the assumptions for our portfolio expectations based on what has happened in the past, right? And but markets are all about probability. There is no certainty about the markets, and I refer to this Markov's principles of the probability, right? What is going to happen from now has no relevance to what has happened in the past, right? So whatever the past, it's going to be of absolutely meaningless to me when I'm trying to look at especially when we are looking at, say, 10 years, 15 years down the lane, and the trends kind of creeps in slowly. I mean, we don't change the sudden shift happening, but it kind of creeps in slowly, and suddenly, one fine day I wake up that, there is something, has completely changed. Things have completely changed, right? So from that perspective, for investors, who are looking to build their long-term, corpus, either for the retirement or for the wealth generation. So I wanted your views on 3 or 4 factors, that one needs to keep in mind, right? When I'm building this long-term portfolio, right? The first and foremost is that if I look at the present generation, those who have retired today, right? I don't think many of them are dependent on SWP as a concept, because they have their source of rental income, they have their interest income as a source, and some of them may have the pension coming in from a provident fund or the guaranteed pension through the government system, right? So that is how majority of the the pensioners are today living, right? That SWP portion is still very less as of today, right? And but in the next 10 years, the current generation, those who are in their 40s to 50s, they've been aggressively building their MF portfolio, through SIPs today. And the SIP books, as we all know, it's like growing, leaps and bounds every year. And primarily those who are building the SIP corpus are looking at someday or the other, I'm going to reverse that and do an SWP, right? So in your experience, based on, that's another trend change. Do you expect a trend change happen in a decade, 15 years from now, right? So where the SWP can be a significant component and which can affect the, the market liquidity, what are your views? I will leave it to you. And maybe I have 2 more factors that I have in my mind that I will probably, pull out after I hear your views on this.
So you're right to say that the previous generation did not need to rely on SWP, and there were multiple socio-demographic factors also. First of all, I think today we are a much younger population than 10 years ago, right? Second is the proportion of government stroke public sector employment as a proportion of total employment was much higher, right? So it is this generation that has seen the private sector, step up in employment. And the second aspect is that in the older generation, the provident fund, which used to give a guaranteed return, was considered, kind of enough of a cushion. But I think that that generation realized it as time passed, that the inflation was actually eating up most of that. I think that awareness was not there earlier, so people would automatically downgrade their lifestyle post retirement to cut the cloth according to the size. They would willingly accept, saying, okay, this is my corpus,
Yeah.
and whatever I can get as an interest from it. And it was also a period of high interest rates, and hence FDs from private companies and banks were also in the double digit for significant periods of time.
Yes.
What's happened is that, wow, the social democracy, what's changed is that these generation, I think the first thing is that they don't want to depend on their children, whereas the earlier generation had the cushion. I know we all had that loyalty towards our parents, and we would make sure that we take care. And as they grow older, one child or the other would come and be with them. So I think all of those, now the nuclear families are changing, and response. So people are thinking that, can I go to a retirement home and live by myself and not trouble my children? And the
Yes.
children also increasingly are being, what do I say, trained by their parents into saying, don't worry about me. I know, take care of yourself.
Yeah.
But so the second is that you should also be aware is the information explosion, the internet, the digital, making knowledge much more easily accessible. So people are able to anticipate the future and plan for it, because they have enough information in terms of past returns, in terms of whatever, to judge it. The third aspect is that I think the concept of FIRE, which you would have heard of, this is financial investment to retire early, right? So a lot of these youngsters are now conscious of the fact that they don't want, like, to their parents be working well into the late 50s or early 60s, and would like to retire and enjoy life. So they're conscious of the fact that since they are shortening their earning span, effectively they need to make sure there is an adequate corpus to take care, and which is where I think the popularity of SWP comes in, right? The
Right.
second aspect I would say is that, from a perspective of the 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 cash flow management, as opposed to just depending on returns for managing, I think that, no, that awareness, that I want to build enough of a corpus so that I'll pull out a little bit of it also. I'm not in the vagaries of the interest rate or the dividend rate, or paid by that institution, by a provident fund or whatever. So I think it's a combination of all these factors which has led to this. And the way I see that advisors and distributors also change their philosophy, because what they are doing is to, when they're taking the money away from a secured bank deposit or a post office savings scheme to an uncertain equity environment, they also feel the need to provide that comfort of the SWP in terms of this, rather than say, like the NPS system. NPS system says you invest it in this into equity, choose your equity debt component, and then you choose what you want later, as opposed to an advisor saying, no, I'm saying that this is the way I see inflation go up. You are in an uncertain, but I'm positive that you will get inflation being returns. Hence, if I put you on a program, then I can give you a reasonable certainty about your cash flows for the future, building in inflation. I think that the knowledge on the part of the advisor from distributor in terms of all these tools and skill sets also contributed to the growth. Now, the question that you asked is that, if you have one hand, your SIPs increase, and then other hand, you are taking away the capital, right? Then there's going to be a challenge for the cash flow for the market, in terms of fund managers having to put in a greater proportion highly liquid large cap assets, and hence not being able to do the proper asset allocation diversification which they would like to do, and the conscious of the liquidity. I do not see that as a threat or a challenge, for the reason that we are just scratching the surface on the SIP growth. So we are running at about just under 30,000 crores of SIP. I see this number can touch a lakh in a decade. So to me, I don't see SWP is growing that fast as the SIP growth. Number one. Number two is that even in an SWP, when you take out the money, right, I still think that what I've seen and what I also recommend to my friends is roughly a 4% annualized Bitcoin. So given that you're going to be earning a return, which is that 4% be at least the amount of inflation beating that you'll do. So to that extent, I believe that the fund manager will be paying out only from the returns and not from the corpus. So what you'll be taking out is more of your gains rather than the meeting the corpus. In a few years, like last year when large cap delivered a very simple single digit return, or you may be drawing down on your corpus. To the
Right.
extent that you're skimming of the buttermilk, the butter from the buttermilk in the churning
Right.
process, I don't believe that SWPs are going to represent a significant liquidity issue in the fund management industry. Right? I don't think that it will grow to that extent. Second is also that while people market this saying a 4% of your corpus every year, right?
Right.
I've seen that people titrate it based on not take a flat 4%, but take a different amount each year based on your then needs, but use the SWP as an annual SWP. We commit the SWP for 12 months, and if the stock market has given you very good returns, then you have the ability to increase it. If it's given less, you take out less this year because what you took out the previous year will smoothen the journey. So this variable SWP is also a concept which people are doing, because why do you take out more than you need? Because when you plan for the future, you'll always build a cushion. And you'll say that I've taken out too much to SWP, I don't need that much to spend. So I think that people will also go through that phase of only taking out as much as they need for their then living expenses. Right. One more factor which has happened is the awareness of the insurance. So I think that with health insurance, life insurance is one part, but with health insurance being popularized, the need for that contingency capital, saying, what if I got cancer? What if I were terminally ill and I need to build that cushion, will come down. You have the insurance policy to cover your extreme medical situations. So I think that also helps the SWP component to be less. So I think that is a balance which will work out. And I don't see yet that the rise of SWPs is going to pose a threat to liquidity management by fund managers.
Okay, so the key point that I'm taking away from this, your views, is that you say at the worst case, we are going to have about 4% withdrawal, right? That's what everybody is talking about. But the growth is going to be much more than the 4%, even including the return plus additional investments that will be coming from the new investors is going to be much more than the 4%. So eventually we're not going to say, see that kind of a liquidity crunch in the market, even if there is going to be a, the pull out from FWIs, which we saw last year, right? So even if that scenario is going to happen, maybe that may happen 1 or 2 years, but happen every year, right? Maybe in that particular year, we will still see some markets, going through a lot of volatility. But I think in a long-term trend, if we look at it, the withdrawal rate is going to be much lower than the net additional rate that we may have eventually, right? Okay, fine. Yeah, so that gives a little bit of a comfort for us, for the next 10-15 years, that yes, we can depend on that, right? The SWP as a concept, right? And the second factor that I wanted to keep in take your views on is that in the last 2 or 3 years on the IPOs, right? I mean, we are seeing a lot more IPOs now, right? And the majority of the IPOs, right, are offer for sale, right, which means the promoters encashing, right? So before the stocks coming out to the market, right, most of the the profits are being taken out privately today, right? So the bulk of the money, right? So which means, I mean, do you see the trend continue again there? And there's going to be a less chance for investors to participate after it hit the market. Is that going to affect the market return? Because we have seen in the last 20 years, the returns have really been, India returns have been significantly higher, right? We've been having 14% for the large cap over the last 10 years. And, the small caps are closer to 20% in the last, in 10 years, right? So what do you see as a next 10 years? Because I think some of the IPOs, some of the stocks which have come in before 2000, like Infosys or something, which are given 50% CAGR, right? Over the last 30 years, they're given 50% CAGR, right? So I don't see any stock giving that kind of a return over the next 20 years. And the new IPOs which are coming in today, right? So is that going to impact my long-term returns?
No, I would only say that. I would say that see, this is a necessary part of a capital market growth, okay, because of the fact that the depth in the capital markets in India, I would say, is still very, very less. Okay, so you need to have far more companies in the listed space come up, right? So I think that to that extent, what I feel is that the flattening of the curve, that is the difference today between the large caps, mid caps, and small caps, is too steep. So much so that in a BSE 500 or a Nifty 500 index, you have 75% weightage for the large caps, right? So I see that that's because of the paucity of good quality companies coming into the market, right? So the penetration of the equity capital markets is still very, very less. And hence you have more money chasing those few stocks and those few winners. And hence the large caps keep getting bigger. And so the concentration risk. So you see a fund manager wanting to manage a flexi cap fund against a BSE 500 or NSE 500 as his benchmark has no choice but to take a large proportion of large caps, right? And which is the risk for the market? Because your large caps getting bigger and bigger. See, why they are big enough companies in the context of the economy, right? They are obviously there, but there's too much of money going into large caps. And so whenever an FII goes through withdrawal symptoms, you face this challenge because that's where they pull out money. So I see that more and more the IPOs come, and you see there are so many successful companies which have grown without using the capital markets at all, and are now coming into the capital markets, right? That's the difference between the decades earlier when a company would come to the capital market seeking capital to grow. And that growth capital gave you fantastic returns because it was reemployed in the business. Today, thanks to private equity, all these companies have got adequate sources of capital to grow the business. And hence, the capital market is being used as a takeout for the private equity to return money to his investors. See, all the private equity also raise funds. They raise funds from HNI investors all over the world. So, it's a natural process of the capital market. See, if a promoter himself, right, I'm talking about the actual founder promoter, not the private equity. If he is selling his stock, that begs a question on why is he doing it. So leaving that part aside, any other person who's part of the promoter, like a private equity or a hedge fund, which had helped this business to scale up, it's a natural private equity to public equity transition, which will give depth. But because of that, because these private equities guys are the well-educated, finance-trained people, they will price their issues at or near to perfection.
Correct.
By investing in an IPO, you can't expect to make those kind of a 50 multi-bagger, which happened earlier. Because only after he has fattened the calf does he bring it to the kill. Brings it to. So that means that today IPOs are no longer that wealth creation engine. They're the form of a retail investor participating in a success story already demonstrated. So if you take a few names, like you take Hyundai, you take LG, these were at proven. Hyundai's market share in the Malaysia that he had transformed the Indian auto industry. LG, along with Samsung, has transformed the durable industry. Was well known. So the LIC, for example, well known player who grew. So now the IPO is only giving you a sense of ownership of a successful company,
right?
And the fact that these successes are demonstrated means that your what do you call this number of times over subscription goes phenomenal because it's a known story. Whereas earlier IPOs, you didn't know. You had to take a bet on an Infosys when they came with an IPO. You had to take a bet on an HDFC because State Bank and the public sector was dominating the space. HDFC entered. Infosys came in out of the blue into a new. People didn't know. So that was real risk capital. Today, IPO is no longer risk capital. Hence, you won't get the reward because there is no risk. Because tried and tested car manufacturer is coming to the market. What is the risk?
Yes, correct.
Right? So you're buying a product which is already well known for it, right? So you have to pay the right price for it, right?
Yeah.
So IPO is no longer retail investors, pot of gold at the end of the rainbow. Okay,
Correct.
IPO is an opportunity for you to participate in a share where most retail investors are today driven by the fact that they expect a pop on listing.
Right.
So the concept that I'm getting something cheap on which I'll make money, whether he sells it or not, is a second decision tool, right? On listing. But he feels that he's getting it cheaper, right? But That is an inherent feeling. But the recent difference between grey market prices and listing prices has pierced that balloon.
Yeah,
right? So those who bought in the grey market thinking I'll get a bigger listing premium are seeing they're not even getting half their price in the IPO. So I think the efficiency of the capital markets in terms of pricing the issues to perfection, and the fact that now you're buying known companies, so the risk is much less. So you're more right as an IPO investor to expect multi-bagger returns because you're buying something which is well known as a success in the marketplace, in the real marketplace, as opposed to. So I think that while you cannot, people have an inherent tendency to try and take a shot at a lottery, right? So IPO is more like a lottery in terms of what is the number of shares you will get and whether you will get a listing gain or not. But it's part of human nature. So you can't prevent people from doing it. But the important thing, what I want to stress, is that from a capital market perspective, these are very, very important. You have to get more depth into our capital market. There are so many industries that are not fully represented. I mean, for long years, Maruti Suzuki was the only listed car company in the Indian stock market. And so you want to play car story, you have to buy only one share, which today is you have Hyundai, you have Mahindras, you have Tatas, everybody is there. So I'm just saying it's very important to have as much of the real economy reflected in the capital market. Then only you can relate your nominal GDP growth to your appreciation in your portfolio. Right? What the nominal GDP reflect if most of those contributing to the nominal GDP are not in the stock market? So I think that I welcome the whole IPO boom from a capital market perspective. And it will also then widen. It will ultimately, over the long run, you will find that the BSE 500 or NSE 500 will be only, say, 55 or 60% large caps.
Right.
As more and more company, you will have the rise. And that's the right situation. Then even if you're SWP creating a liquidity, you'll have a far larger number of highly liquid stocks to be able to sell. Today, the problem is because it's concentrated in the top 50 or the top 100 companies of the country.
So I think, again, here the takeaway for me is that, yes, we are going to have a lot more companies, and we're going to have a lot more stable companies, tested companies, rather than untested companies available for investors, retail investors in the capital market, right? So the untested companies are getting pushed out to the HNIs and the ultra HNIs and in the private space. And for the, the regular retail investors, they're going to get more and more stable companies, which probably reduce the risks. Maybe the rewards are also can come down, but the risks also, reduced to a large extent, and which can, support the, kind of the returns expectations that we have been seeing, in the last decade or so, can possibly continue, with a lesser risk in the system.
The only thing to add there is the only segment where that old story still remains is the SME IPOs.
Yeah. Okay.
Okay. You don't have the knowledge, and you also have this saying that can I find the next Infosys from the small cap exchange? So that exchange is a different exchange, and where there is no proper information and there's the pump and dump stories which prevails. So that's a completely different kettle of fish.
Yeah, and I think even the larger VCs or the PE players are also not getting into those kind of companies, right? I think it's probably again untested merchant bankers who are playing role in that segment as well, right? So I think there's the two questions that we have gone through. One is that the SWP with a 4% max withdrawal rate, and second, the depth of capital market increasing. Maybe with a lesser risk, we are looking at a lesser risk going forward, and the returns may also be proportionate to the risk that we're going to take in the market. And still, retail investors have a fairly a good chance over the last 2-3 decades to build their long-term portfolio through the established capital markets today, right? And the third thing is that I wanted to check with you is that on those, there are a number of companies not taking investments, the bigger ones, like for example, the Zerodha and Zoho. They are the two classic Indian companies which I have seen, who have not taken any capital. They've been able to grow organically by themselves, right? And is that a trend that you are seeing? Because what is happening is when I'm trying to bring in a VC or when I'm trying to bring in a private equity into the company, so they have a lot of expectations because they're trying to squeeze out everything, whatever possible that is available. and leaving very less on the table for the promoters at the end of the day, right? So there are many promoters who are also thinking that, okay, and today the risk taking ability with the promoters are also very high, and also with the previous generation of wealth that is available. I mean, a decade back, we did not have so much of wealth in India, but I think now, we have comparable to some of the large countries today in terms of wealth available in the country. And there are many next generation entrepreneurs who can very well say that I don't need a external funds to build my company. And plus, with all technology emerging, right? So AI and all that thing happening, I can do a lot of things with a less number of people. I can do everything on cloud. The investment required for building a unicorn today is not as high as what it was in 2000, right? So where even if I have to build a simple website, I would end up spending $10 million, right? Today I can probably do it overnight, and put my business model together there. So the requirement for the capital itself, right, may not be that much. And I also have capital within the family available to build that enterprise. So with that, which also means that the number of companies who are coming into the capital market or accessible to VCs and PEs is also going to get lesser, right? What are your views on that?
I see that as at the very much at the margin. So Sridhar Vembu saying, I don't want to list because I don't want to be answerable quarterly to thing. I can never do growth investing if I have to report every quarter. I think that's at the margin, because by and large, if you see, I think that the growth capital only the VCs and the private equity can provide. And it is not a choice of the promoter or the founder of the company to list. It is a choice of the VC or the private equity to list. So you're taking it out of your hands, number one. Number two is that I see that I see these as exceptions to the rule rather than the rule, for the reason that today's employee, right, one of the biggest ways they're looking to create wealth is through stock options. Right. And if you're not going to list your company, you're going to lose out on the talent in the industry. Right? So I don't see this as a sustainable phenomenon. And also can come and do that, or a Zerodha may do, or whatever, right? They are at the extremes. So the bulk of the risk capital, I think, provided by the PEVC will continue, according to me, because that's deep risk, right? It's not something. Second aspect is that, like I said, if you want to get good quality employees are no longer satisfied with just a salary. The kind of money that you have to pay to them to compensate for non-availability of stock options. It's push on the P&L of the company.
Right.
So it's a delicate balance that you have to do, right? And, some are able to carry it off, but I still see that 80% of the companies in new age businesses will need private equity at an early stage to back them so that they can take the investment ahead of the returns. And hence, I see that it's not going to change very significantly. I see that ultimately there will be a steady pipeline of private equity funded companies coming into the capital markets.
Okay, so there will be enough supply that will be available to us, in terms of companies coming into the capital markets to raise funds, either in the form of even if it is going to be offer for sale, right? Even then, it's going to be good for this thing, and we might see more companies coming in for the growth capital also. There could be opportunity for us to participate in the growth capital as well. Although there may be very few, but there'll be enough opportunities for the high HNIs and maybe less for the retail investors. Is that the takeaway that we can have?
That is right. And also, we are forgetting one more thing, that how does an entrepreneur feel that he's succeeded?
Yeah.
Today, the world is wired to capital market wealth, saying that you have arrived, right? As the entrepreneur, right? So why I'm saying this is, without listing, how will you discover what you've created? What is it worth? An unlisted company. I mean, there are the Sridhar Vembus of the world. I'm saying they're at the margin. But an entrepreneur sets it up and does it, right? I'm saying he will look at it like saying, my personal wealth, I've created it. It's the capital market which provides a route to a democratically determined wealth criteria, which is the market capitalization of your company, right? Absolutely. That's the only way that the world knows you're a success. You've done all the hard work, and you go away feeling, oh yes, I've been a success. But only the capital market will tell you what is that value of that success. So I think let's not discount that. An entrepreneur took all the risk for what? End of day, he wants to have created that wealth. And you also look at it this way, right? It's also a social thing, right? So if Ambani has never listed, right? I mean, clearly, Dhirubhai, when he did the listing, he said, look, I am taking risk capital from the public. I want to give them the returns, right? But the key element is that you have to have that vision of so you create, not only does your company create wealth for you as a promoter founder, you create wealth for millions of people who have invested in your shares. So I think that's a larger purpose also, which is not just from a personal wealth creation perspective, but that you've made so many millionaires and this out of the, it gives you a sense of satisfaction. So I think there are a lot of things which drive this process, and I'm sure that I don't see that waning. And I see that increasingly the capital markets will be the ultimate litmus test of the fact that like take again Sridhar Vembu's words that I don't want to be answerable quarter to quarter, but by going into that fire of the capital markets, you are saying okay, I will handle that fire quarter to quarter and still grow. It's a challenge in itself. It's one thing to say, oh, I don't want that challenge and let me run it the way I do. It's one. There's no right or wrong, but I'm just saying that it's another way to look at it, to say that, oh, I need this quarterly. And you have companies like which says, I don't give guidance. So you can make these choices in the capital markets, right? So I'm just saying that the capital market is wide enough to accommodate all kinds of people. And there will be the odd people who will say, like an IKEA, who will say, I keep my company private. So that's fine. So I'm just saying, we've all players, but I don't see there's an increasing thing. I see that listing in the capital markets is something that every entrepreneur, 8 out of 10 entrepreneurs will want to do. And they will have to take private equity. And once you take private equity, capital market is only take out. Unless you sell one private equity, sells his stake to another private equity. But ultimately, the ball will come rolling that one private equity person will say, no, I want to cash out.
So I think, to summarize 2035, if you have to look at it, a decade from now, not much will change from what we are today, right? I think the markets are going to be much more broader, as you say. I mean, we're going to have more and more companies there, and more companies which are tested out, right, by the private equity, and it has gone through the, a lot of due diligence, which have established the business model, and they're going to come into the markets, and we will have enough of that coming into the market to feed, the investments that are going to come in from the next generation, because who are like, the SIPs are going to increase, all that is going to happen, and we need more and more companies to, available for these capital which is chasing the market today, right, from the retail investors. So that's going to happen, and it's going to be a lot more broader market that we're going to see in the next decade or so. Right?
Also, one more thing that happened from I would say regulatory or maybe government perspective. Let me say it's a big thing. You talked about the IPOs booms which have delivered multi-baggers. One of the reasons was that their early stage financing was done by banks and by ICICI Limited, IFCI Limited, and IDBI Limited, the long-term lending institutions.
Right.
The very fact that they have been done away with and merged, it means there's a huge shortage of long-term debt capital, and the Indian debt market is still not. You don't see 10-year debt issuance coming and taking, right? You get 2 to 3 years. NBFC is largely tapping the debt capital markets. So the equity capital markets only have to finance the growth. So that's the way the government, because public sector banks, because they went through the cycle of bad NPAs. So the ability of them to take this risk in financing project finance,
correct,
this won't be as big as before. So to that extent, it's the capital market which has to support growth capital. So I'm just saying that the whole system, whereas in the 2 decades earlier, the banking system was providing the risk capital. There was not much of private. There was not much of this. And banking system as an IFCS and the lending institution plus the bank. No longer that. No, we don't have a dedicated term lending institution at all today, project financing institution.
Correct.
So to that extent, now you have to get in, and which is where products like REITs and will grow and substitute that space to some extent. But you need equity capital at the back of it from the capital market. So,
and I think even the debt capital is also moving towards the market now from the institutions which used to be issuing a larger debt, right? So now it's all coming into the open again now, because I think
AIF's also playing a part there.
AIF's also playing the part there. So, and also I think that given the the reduction in the debt which is, as you said, double digit about a couple of decades back, to we are looking at very low single digits going forward, right? So the only way that the investors can balance their portfolio is having a little more higher of the equity. I need to have the allocation, but the equity allocation may actually be little more than what I was maybe a decade back, right? So that is also will give more capital, equity capital to the market. Yeah.
Absolutely. And because like you said, if you just see one statistic there,
Mm.
over 2014, the bank deposits, mutual fund proportion of bank deposits was 10.6%, 31%.
Yes.
So clearly shows you that the newer generation is not preferring bank deposits as a source of their, so that automatically, whether you like it or not, the capital markets are going to get that flow.
Yeah. And I think that's also the income tax regulation, the advancement that has happened in their technology to track all their fixed deposits, right? I mean, even few years back, 5 years back, hardly, you had to voluntarily disclose your FDs. It's no longer voluntary disclosure of FDs anymore. It is like it's mandatory now, right?
Not even forget mandatory. I don't have to tell my chartered accountant what my FD interest is.
Exactly.
Your AIS has already reported this.
Reported everything. Yeah. So that has given a lot of education to people in terms of why I should move from FDs to my AIS. Has actually made people move from FDs to money market funds. Yes. Yeah. So thank you, sir. Any final words before we close the session from your side on this topic, summarizing this overall views? Yeah.
I basically like to,
and for the next generation, like next 10 years, 20 years, the people who are building their huge 15, 20 crore corpus for their the retirement, and making sure that they have to draw out for the further 30 years, right?
So I think that basically the history, you mentioned history at the beginning, that the only thing that you can look at is history over a long term, right? Versus history over a short term. I think over a long term, history is reasonably repeatable because it sees market cycles. It's in the short term that your history, depending on history, means that you have to see the exact correct history. If you're a bull phase, you could look at the previous bull phase. You're the bad phase, you go to the previous. But it's very hard in the middle of a phase to know whether you're in a bull or a bad phase. So that's what makes history. But if you see the long run history, right, that the capital markets have always delivered better than nominal GDP.
Yes.
Right. So ultimately, then if you then look at it that where should your money be? Your money should be in that country which has a high nominal GDP, because that capital market is going to beat that. Right. So I think that, and the component of the nominal GDP that comes from the real GDP is also important, because you can grow your nominal GDP having a high inflation rate. So I think that if your real GDP growth is at least 1.5x your inflation growth, right, then the ratio is right, because then that real growth is going to beat inflation.
Right,
because there's always been a lag between this. So I think countries like
India is in the a very high sweet spot, right? Isn't it? That's what I
was about to say, because India is in a 3.5-4% inflation and in a 6.5-7%. So it's that ideal 2:1 ratio. So your capital markets will deliver basically that inflation beating return because of this ratio happening. So I think that's the reason why equities are the best asset class. And the other thing is that the cyclicality is inevitable with equity markets. So what cyclicality teaches you, history, again having come in on history, is that always buy something which goes down because they had to come up. That is the beauty of cyclicality, right? So at the time, and that's why Warren Buffett and others, they say whatever. I don't know whether Warren Buffett said this, but buy when others are fearful and sell when others are greedy. So it's typically a bull cycle when everybody is greedy, which is when you can probably look at taking off money off the equity table. And so when I do this in structuring your SWP, if you feel you're in a bull phase, then you can automatically tweak your SWP to take advantage of that, so that in a bad phase, you reverse the situation. So what I'm trying to say is SWP remains a good core tool, but a dynamic SWP will probably help to smoothen that curve a bit more and make sure that you leave enough on the table for the future, and enough to take care of your current and present needs. So I would say that a dynamically managed SWP to me is from
Yes.
a largely equity-oriented portfolio, I think will
Correct.
stand the test of time.
Okay. So thank you, sir. Happy Diwali once again. And I think, it's been a great talking to you and your views on these subjects, which has been like bothering me for quite some time, right? So thanks for sharing your views. And I think final word, I think it's just, I mean, I have to depend on capital markets for my long-term growth. That's the final word that we can go away with for this Diwali, right? And then look forward to a better Diwalis ahead. Yeah.
Yes. Okay.
Thank you.
Thank you. All the
Thank you,
best.
sir. Thank you.
So that was today's episode. Thank you very, very much for listening in. We hope to see you soon. This podcast is intended to provide helpful and informative material on the subject matter covered. It is given with the understanding that the podcasters of this material are not engaged in rendering professional services through this program. If the listener requires personal assistance or advice, a competent professional should be consulted. The podcasters specifically disclaim any responsibility for any loss, liability, or risk, personal or otherwise, which is incurred as a consequence, directly or indirectly, of the use of any of the contents. The contents are general information that is intended to, but not guaranteed to be correct or updated. The information is not presented as a source of investment, insurance, or legal advice. You should not rely on the statements or representations made in this podcast or by any externally referenced sources. If you need investment or tax advice upon which you intend to rely in the course of your financial and business affairs, please consult a competent, independent, registered financial advisor. The content should not be taken as financial advice or as an offer to buy or sell securities, insurance, funds, or any financial products. It should not be taken as an endorsement, recommendation of any particular company or individual, and no responsibility can be taken for inaccuracies, omissions, or errors. The information presented is not to be considered as investment advice. The podcasters do not assume any responsibility for actions or non-actions taken by people who have listened to this program, and no one shall be entitled to claim for detrimental reliance or non-reliance upon any information provided or expressed herein. Your use of any information provided herein does not constitute any type of contractual relationship between yourselves and providers of such information. The podcasters hereby disclaim all responsibility and liability for all use of any information in this program.